Welcome back. We've got the market, which is up 100 points now, and it's started absolutely flat, absolutely slow, but I think we've picked up nicely. So the market indeed is paying attention at the margin to what happened last night with regards to that phone call between President Trump and Prime Minister Modi. I mean, the momentum has been there in any case. You can add two and two together. You can perhaps try and put attributing reasons to what the market's sensing. But general sort of right direction in that sense. Insurance is what we're going to focus on in our segment, Quarter se Quarter Tak. Let's put the spotlight on what to expect with regards to the top insurance companies. Yash is standing by to give us a preview, and then we will bring in an analyst to talk about this. Yash, over to you.
Well, Prashant, it's been an eventful quarter for the life insurance companies. A new regulatory body chairman coming in. Government announced GST changes having additional cost implications for insurers, and then insurance companies passing on that cost implication to distributors to somewhere insulate their financials. Kotak Institutional Equities expects it to be a quarter of anxiety and weakness. As far as annualized premium equivalent or APE is concerned, Kotak expects Axis Max Life Insurance and HDFC Life to fare better than the peers. So for Axis Max Life Insurance and HDFC Life, it expects an APE growth of 14% and 10% respectively. For SBI Life, LIC and ICICI Prudential Life Insurance, Kotak expects APE growth to drop by 1%, 1% and 4% respectively. Now, as per Kotak Institutional Equities, VNB trend is expected to remain muted. Axis Max Life Insurance expected to deliver the highest VNB growth of about 20% in the quarter, followed by HDFC Life at 11%, followed by SBI Life at 7%. ICICI Prudential Life's VNB growth expected to remain flat, while LIC expected to see a drop of about 3% in its VNB. Now, post the GST changes and, importantly, the disallowance of ITC, that is expected to weigh on the margins. The industry, expected to see a margin drop of anywhere between 50 to 150 basis points. Valuations have remained largely stagnant. Max Financial, HDFC Life trading at about 2.2 times FY27 price to embedded value. LIC trading at about 0.6 times FY27 price to embedded value. Now, importantly, 5 things to watch out would be the impact of GST and changes on the margin. Second thing, passage of commission to distributors and absorption of the cost. Third thing, demand outlook for the second half of FY26. Next thing would be commission trends for the second half. And finally, demands which the insurance companies have placed with IRDAI chairperson with respect to release of risk capital, also spreading out of expenses because of the GST changes through the policy term of any given policy.
All right. Yash, thank you very much for that. Nischint is with us, analyst at Kotak Institutional Equities. Nischint, Yash was referring to your report, saying that's a quarter of anxiety. So just start there, Nischint.
Yeah, so it's been it's been a volatile 3 months, right?
Yeah.
First month was fine. August volumes were weak, given the fact that everybody was waiting for the benefit of GST exemption, and I think finally you saw some pickup in business in the month of September. On a YY basis, it appears to be less impressive, like the 9% private sector growth. But keep in mind that last year, in the same quarter, there was a lot of flash sales, before the surrender value guidelines came in. So on a 2-year CAGR basis, the industry has fared fine. We are closer to around 15%. So, well, that's not a bad outcome. And so the more important aspect is, how does demand, move from here on? Clearly, insurance prices have been lower. You've clearly seen, prices going down for term and for health, even for the other products to some extent of, whatever extent GST was there. So does that really help to stimulate demand? Does that really help you to kind of, reduce your sales effort? And I think that is going to be the positive, outcome that we are expecting to see. I think on the other side, as we said, the loss of input tax credit or ITC, how that gets shared between the distributor and the insurance company, I think that's something that we'll have to see. So those are the two things that one is really watching out for. This quarter per se, these results are less relevant. What pace of VNB growth is there in this quarter? That's less relevant. what is the outlook for these two aspects is something which is very crucial.
Absolutely. For a quick second, if I can ask you to comment on, we reported yesterday, Nischint, that post this GST cuts, etc., post the GST cuts, insurers wanted to sort of pass this on to consumers by cutting commissions, etc. Distributors like PB Fintech, etc., have pushed back, and looks like insurers have relented. There are renegotiations, etc., going on. Any way to think about this, and how important is this for a player like, I don't know if you have coverage in PB Fintech or insurers on the other side?
Yes. So I think, the one good thing that's happening is that, you've seen tariff for the customer going down. And, there is a resolve that, it remains low. So whatever is the burden that has to be shared between the manufacturer, or essentially insurance company, and the distributor. So I'm sure it is, there is a to and fro. It's like a game of chess, right? So you negotiate on some aspects, and you find the middle path. The end of the day, what is expected is that you should see volume buoyancy. You should see more people inclined to buy insurance, and that will improve your operating leverage, and that should ideally offset, all the losses and the discussion that we are having right now. So the intention obviously is that, this should actually be a more virtuous kind of an output. That's where I think that is a desirable outcome.
Got that. Fair enough. Now let's talk about individual companies and where, for our viewers, given all the uncertainty and the road ahead. The quarter, of course, as you said, is not so important. How would you rate the companies under your coverage in terms of their ability to do well in this environment, given as things are?
So see, companies today, as I said, things are fluid, and that's why we use the word quarter of anxiety. But companies have multiple options. It's the decision that they make will determine, how things are going to play out. At the same time, there is competition between companies, and there is a distribution dynamic. So that's how I think kind of things are a little hazy. Having said that, I think if you look at specific names, HDFC Life, generally a player who tends to kind of balance out margins and growth, kind of has always been more on a balanced side on some of these things. I think we would expect that they should have a reasonably good ability to sail through these things. We would expect some swing in margins, maybe for this quarter, but margin broadly remaining in the same range and taking it up from there. I think likewise for SBI, right? SBI is generally a low-cost player, and which is the reason this full loss of input tax credit impact should also be lower for them. And the second thing is that SBI, or State Bank of India as a franchise, has been weak for a while now, right? You're sitting on a fairly low base. And if one says that, look, this is going to stimulate demand, at the grassroots, then probably SBI Life should benefit a lot on the volume front as well. So these two companies should be fairly well placed. ICICI Pru Life, is again a player where you're probably seeing a base effect playing out on volumes, but the dynamics in terms of how the margins, etc., evolve is something that you'll probably have to see.
Yeah, got that. Nischint, from a overall, we got a new person at top at IRDAI as well. Another story we reported on was, this broad focus once again on sort of commissions. There was that Bima Sugam earlier. The idea. What's your sense there, Nischint? You think that's going to remain a focal point as well?
See, the point, I guess, the principle, that IRDAI is following is that, look, there is an cap on expenses. So with that, what you pay to the distributor, what you pay on yourself, I think it's completely left on to the company, and companies can make a choice. Somebody would say that I would do business mostly with banks. Somebody would say that Policy Bazaar is a great partner. Somebody would say that, no, I'm going to balance all these things. It's really on to you. So should distribution commissions be down? Well, the cost of doing insurance, or the cost of reaching out to the customer, should go down, right? One can say that I'm going to cut down commissions. One can say that, well, I will not cut down commissions, but I will cut down some other expenses. Or somebody else could say that, look, the sales process has become a lot more easier. The product has become a lot more appealing and affordable now. So even if commissions go down, it doesn't really matter, right? So that's the dynamic. So I know we keep on really talking about, X% impact on the distributor and Y% impact on margins for a company. But we'll have to see how the dynamics evolved on demand. That will be the most important driver going forward. At the same time, how do distributors react? Does it become, less viable for newer, younger breed of agents to come into the industry because if the commissions go down, and hence in that scenarios, how do insurance industry kind of assess out its margins and agency commissions? I think those are also the things that we'll have to see.
Yeah. Got that. Nischint, we'll leave it there. Thank you very much for joining us, and we'll, I hope, speak after numbers start to come through for an analysis of what they show us. Well, I think we want to focus on another